Hey everyone, welcome to the very first episode of the Accounting Starter series. The Starter series is actually made up of 5 parts, and all these videos will focus on the basic and foundational concepts, terms, and other information that you need to master first before you proceed with more complex lessons. I decided to make this series because I found that a lot of people find accounting difficult, mainly because they did not have a solid foundation or a good understanding of the basics. This beginner-friendly series is suitable for those who have absolutely no background in accounting or those who want to learn how to master the basics of accounting. In this series, I will try to simplify the lessons and make them more relatable and understandable for beginners. I've also organized the flow in the order which would help you understand them better. In part 1, I will be giving you a general background of accounting, just some simple definitions, concepts, and principles that would be applied throughout our future lessons. Then in part 2, we talk about the account names most commonly used in accounting. Then we move on to part 3, where we talk about the accounting equation, or assets is equal to liabilities plus equity. Once we have the foundational skills from parts 1 to 3, we are now ready to record the journal entries in parts 4 and 5. We talk about journal entries for service type businesses in part 4 and merchandising businesses in part 5. Now, for those of you who are new to accounting, I would suggest that you go through all the videos in order from 1 to 5. Okay, so as I've mentioned, this video will focus on the general background of accounting. We'll start off with the definition of accounting, and then we'll distinguish between accounting and bookkeeping, which are terms that a lot of people think are one and the same, but they're not. And then we move on to understand the purpose of accounting and the different types of businesses which make use of accounting. After that, we'll talk about the accounting process, all the steps involved in completing a cycle. And lastly, we talk about the principles, some assumptions and concepts that serve as the foundation of accounting. So before everything, the first thing that we need to understand is what exactly is accounting. There are a lot of definitions available, and the first one is actually by the AICPA, or the American Institute of Certified Public Accountants. It states that accounting is the art of recording, classifying, and summarizing in a significant manner, and in terms of money transactions and events which are, in part at least, of financial character, and interpreting the results thereof. I know a lot of times we're tempted to just memorize definitions like this, but here I'd like to break it down into parts so that we could understand it better. First of all, accounting is an art. So you might find this weird because accounting is usually associated with numbers or math and not really with art or creativity. Well, it's mainly because in some ways you do need creativity in accounting, just not in the traditional sense where we draw or paint. For example, you need to be creative when preparing the reports. You need to find ways to present information to make them easier to understand, and you might want to use visual charts or graphs or tables, highlight important information, you make sure that the format is presentable, and so on. Because in accounting, making sure that the information is communicated effectively is just as important as making the right computations. The AICPA's definition also presents 4 main procedures in the accounting process, and these are recording, classifying, summarizing, and interpreting the results. Recording means to record or list down transactions in chronological order. For example, recording all the sales made by the company for each day. So after recording, we usually end up with a lot of information. So imagine if the company has 1,000 sales transactions per day, then at the end of the year, you're going to end up with 365,000 sales transactions. And that's on top of the other transactions that you're going to have, like purchasing goods or providing services and so on. Of course, that amount of information would be quite difficult to manage, so the next step is to classify them. This means that we group similar information together. For example, all sales transactions should be grouped together, and then we get the total amount for the entire period. This way, the information would be more manageable and also more sensible. The total amount of sales would actually be more useful for owners when making decisions as compared to the value of a specific individual transaction. After classifying, we then proceed to summarizing the information. This refers to the process of producing reports, in this case the financial statements, to communicate the results to users. For example, after classifying, you now have information about the total sales and total expenses of the period. So this information can then be summarized to produce the income statement, where they are analyzed together to compute for the net income. After preparing the reports, the last step is to interpret the results and make decisions based on that information. If the company resulted in a net loss, then it means that the company is losing money. The owners may want to investigate the reasons behind it. So are the sales too low, or are there unnecessary expenses? Should the business shut down or continue, and so on. From this definition, we know that accounting covers not only the recording process, but also the way we organize information to make it more sensible and meaningful, and use that information to make decisions. Now I'd like to draw closer attention to the phrases "in a significant manner" and "in terms of money, transactions, and events," which are in part at least of financial character. So what exactly do these phrases mean? In a significant manner just means that in accounting, information produced should be meaningful and relevant to the users, something that would be useful for decision making. So when classifying and summarizing information, or when making a report, the information that you choose to present or highlight, and the flow or the way you present it, should be aligned with this goal. Financial character, on the other hand, means that the specific transaction or event can be measured in terms of money, like 1,000 pesos or $100. An example of an event is where the typhoon flooded a company's warehouse and damaged its stocks of inventory. So this event has a financial character because the inventory was damaged, and the value of the inventory that was damaged and no longer saleable to customers would now be considered a loss to the company and should be recorded in its books. Now, if the typhoon did not cause any damage to the company, then the event would have no financial character. So in that case, there's no need to record it in the company's books. Another definition for accounting is provided by PICPA, or the Philippine Institute of Certified Public Accountants. Here, accounting is defined as a system that measures business activities, processes given information into reports, and communicates those findings to decision makers. PICPA's definition is actually quite similar with the AICPA's definition, only it was phrased a bit differently. So instead of recording, classifying, summarizing, and interpreting the results, here accounting includes measuring business activities, processing the information, and communicating the results. So measuring means valuing something in terms of money, which is similar to the definition of financial character which we discussed earlier. Processing of information means you record the data and you manipulate it to make it more meaningful. So measuring and processing actually covers the recording, classifying, and summarizing processes in the AICPA's definition. The last is to communicate the information to decision makers, and this is usually done via the reports being prepared through the summarization process. So communication here is actually equivalent to the summarization and interpretation of results in the AICPA's definition. On top of these two very technical definitions, the third and probably simplest way to define accounting is, it is the language of business. It is the means used by businesses to communicate, to talk to owners and other report users, to inform them about the condition and the performance of the company. So next, we'll distinguish between accounting and bookkeeping. I know a lot of people think that they're two of the same things, that they are interchangeable, but they actually have some differences. To define the relationship between the two, I think it's easiest to imagine an inner circle within a larger circle. Bookkeeping is the inner circle and is actually part of accounting, which is the larger circle. When we talk about accounting, we're actually pertaining to the entire system, from the analysis of transactions, recording, classifying, summarizing, preparing of the reports, and communicating the results. But for bookkeeping, we're actually just talking about one step in the accounting cycle, which is the recording process. So now that you know the difference between the two, next time make sure that you're using the right term. Now let's move on to the purpose of accounting. Why exactly do we need to perform the accounting process? First is we need to accumulate and report on the financial information about the entity. So this financial information can include the financial condition, performance, and cash flows of the company. And by supplying this information, users like business owners can now make better decisions about the company. From here, we see that the main purpose of accounting is really to collect data and produce information and reports that will be useful for decision making. And for us to be able to achieve this purpose, another important thing that we need to understand is who exactly are these users and what kind of information do they need. These users can be classified either as internal or external users. Internal users are those found within the business organization. These would include the owners, the management, and the employees. Owners are, of course, interested in knowing whether their investment is paying off, if the business is growing, earning, or making money. Management requires information to make better decisions about the company. For example, are they meeting their targets? Are they losing or making money? Are their strategies working to increase sales? If not, then they might make adjustments to those strategies to improve them. Then for employees, their interest is about the stability of the company. Since they're relying on the company for their job, they need to know if it would be able to continue in the long run, if the company would be capable of paying them their salaries. External users, on the other hand, are those who do not own or are not employed by the company. They are those outside the business organization. These would include your creditors, potential investors, tax authorities, government regulatory agencies, suppliers, customers, and others. Creditors are lenders of money like banks or lending agencies, and they're mainly interested in the company's ability to pay them back. Potential investors, on the other hand, would like to know if the company is operating well, if it's worth investing more money, if it's capable of growing and providing a good return on their investment. The third is tax authorities like the BIR. So they would require information to assess the amount of taxes that should be paid by the company. The fourth is government agencies who would require financial information to determine the compliance of the company with the government's policies and reporting requirements. For example, the Securities and Exchange Commission, or the SEC, would be interested in determining whether the company has complied with all the reporting requirements. External users also include your suppliers and customers. Suppliers would be primarily interested in assessing whether the company has the ability to pay them back promptly or if they have the potential of becoming a long-term customer. Customers, on the other hand, may be interested in the ability of the company to operate in the long run, especially if they do plan to be dependent on the company's products. Take, for example, a restaurant looking for a supplier. Of course, the supplier should be able to meet the quality required, deliver on a timely basis, and also be able to do so continuously. And then we have your other users who are not directly engaged with the company, but are still interested in their financials. These would include your researchers who need the financial data for their study. Now we'll talk about the different types of businesses which make use of accounting. There are actually a lot of ways to classify businesses, but here we'll just focus on two ways, which are number one, by ownership, and number two, by activity. When classified according to ownership, we have three types: sole proprietorship, partnership, and corporations. The main difference among the three types is the number of owners. The first one is your sole proprietorship, which has only one owner. It's the easiest to form because of the minimal legal requirements. But there are also downsides to a sole proprietorship. Number one is you have limited capital since you only have one owner. Number two is you have unlimited liability. So this means that if the business goes bankrupt, your creditors would be able to come after your personal assets like your house to pay off your debt. And number three would be having a limited life. So if the business owner dies, then the business has no choice but to shut down as well. Next is your partnership, which is characterized by two or more owners who call themselves partners. One advantage of a partnership would be having more capital than a sole proprietorship because you have more investments coming from different owners. Some downsides to a partnership would be number one, having limited life, since the partnership may end due to the death or withdrawal of at least one partner. And number two, you have unlimited liability, which is similar to what I explained under sole proprietorship. The third is the corporation, which is owned by five or more owners who we call as stockholders. There is a special type of corporation which is owned by only one person, and we call this a one-person corporation. However, this structure is fairly new and quite rare, so we're just going to stick with the typical corporation that we know. So the advantage of having a corporation would be having a greater amount of capital as compared to your sole proprietorship and your partnership. Another advantage would be the limited liability stockholders have. So this means that even if the corporation goes bankrupt, your creditors would not be able to come after the personal assets of the stockholders to pay off the company's debts. A third advantage would be having a limited life. So unlike the sole proprietorship or partnership, even if an owner or a stockholder of a corporation dies, the corporation would still be able to continue operating indefinitely. But there are also downsides to forming a corporation, which includes number one, the difficulty information because of greater legal requirements and papers to process. And also number two, you are subjected to an increased level of regulations from the government agencies. Another way of classifying businesses would be according to their activity. So under this classification, we come up with three categories, namely service, merchandising, and manufacturing. A service type business would be involved in the provision of various forms of services. So for example, you have accounting services, repairs, graphic design, and consulting. The second is the merchandising or trading business, and this type of business is involved in the buy and sell of goods or merchandise. These would include your groceries and bookstores. Third, we have the manufacturing business, which produces its own goods. It converts raw materials into finished goods for sale to customers. These would include your clothing manufacturers and toy factories. Alright, so now we're moving on to the accounting process. As we mentioned earlier, accounting is actually a process with multiple steps in between. So just a fair warning, this might be a lot to take in for beginners because there are a lot of terms and concepts that might be new to you. But eventually, as we go through each step in detail in the next videos, I know that you'd be able to master everything by heart. So just think of this as kind of an overview of the entire process of all the topics that we will be discussing in the future. The process actually begins with analyzing a business transaction, understanding what was given and received by the company. After analyzing, you can now proceed to journalizing. The journal entry is recorded in the general journal, or what is sometimes referred to as the book of original entry, because this is the point when the details of the transaction are first entered or recorded into the company's system. Here is a sample of a general journal where all the journal entries are recorded in chronological order per day. We'll talk about journal entries in detail in parts 4 and 5. Now, at the end of each period, usually at the end of each month, amounts are transferred or posted to a general ledger like this sample here. The process of transferring amounts from the general journal to the general ledger is called posting. One ledger is maintained for each account. An account is a record used to sort and store transactions. So for example, you have the cash account to record transactions that increase or decrease the company's cash balance. You can also have the sales account to monitor any sale made by the company. Posting to the general ledger classifies all transactions during a period into their specific accounts. After posting, we are now able to compute for the running or the ending balance of each account as of a specific date. For example, all cash transactions for January can be summarized in one ledger. After that, we would be able to compute for the company's cash balance as of the end of January. After posting to the ledgers, we now have the total amount for each account used by the company. We then proceed to preparing the unadjusted trial balance. Here is a sample of a trial balance. It's actually just a listing or a summary of all the accounts in the company's books with the corresponding balances categorized either as debits or credits. We will talk more about debits and credits in part 4. Take note that this is called an unadjusted trial balance. From the name itself, we know that this trial balance is prepared before any adjustments are made. Another thing to note is that there should always be balance, meaning the total debits must always equal the total credits. After this step, the company would then prepare the adjusting entries. So why do we need adjusting entries? To make sure that all expenses and income are recorded in the proper period, to adjust the account balances to their correct amounts. We'll talk more about this in a separate video. After recording the adjusting entries, we can now prepare another trial balance similar to the one in step 4. Since this is the trial balance prepared after considering the adjustments, this is now called an adjusted trial balance. Next, we now prepare the financial statements, which are the main reports or outputs produced in the accounting process. These contain information about the company's financial condition, financial performance, and cash flows. The financial statements include the statement of financial position, the income statement, the statement of changes in owner's equity, and the statement of cash flows. After preparing the financial statements, we now move on to closing the temporary accounts. Closing means transferring the temporary accounts, like your income and expense accounts, to the permanent accounts, your balance sheet accounts, more specifically, the capital account. This means that the balances of your income and expense accounts are reset back to zero in preparation for the next period. After closing the accounts, we are going to prepare another trial balance. But since this is prepared after closing the temporary accounts, this is called the post-closing trial balance. So the difference here is this trial balance no longer includes your temporary accounts since they already have zero balances. The last step is called the preparation of reversing entries. So this step may or may not be performed depending on the type of adjusting entries prepared in step 5. Some adjusting entries require this step while others don't, so this is also known as an optional step. Most accounting cycles would just end with the preparation of the post-closing trial balance. We'll be learning more about adjusting and reversing entries in future videos. But take note that unlike other steps made during the end of the current period, reversing entries are made at the beginning of the next period. Now we're here at the last topic for this video, which is the principles of accounting. These are just concepts and assumptions that support the procedures and rules in accounting. Here we'll talk about 12 of them, and I know it's a lot, but we'll take it one at a time. The first one is called the entity principle. Simply put, a business is a separate entity from its owner. So if I own a business, if I invest my cash in the business, the cash is no longer mine. It's the company's cash already. So any personal expenses and transactions of the owner should not be recorded in the books of the company. For example, if I own a company and I get my hair done in a salon, my salon expense cannot be recorded as a company expense. The second is the time period or periodicity assumption. From the name itself, it means that the life of the company is divided into time periods. This is important because the life of the business is indefinite. We're not sure until when it's going to go on continuously. So having shorter time periods will allow us to obtain information and reports that are timely relevant, and useful for decision making. If we don't divide the company's life into shorter time periods, the information might become outdated and useless for making decisions. Time periods may vary per company, so some may have it per month, some per quarter, or some even per year. But the important thing to note is that time periods should be of equal length and should be consistently applied throughout. Third, we have the monetary unit assumption. This just means that all transactions that would be recorded in the company would be measured in terms of money. So it can be in pesos, US dollars, Chinese yuan, whatever currency you choose, as long as it's measured in terms of money. For example, you own a bookstore. So assuming you have 100 books in inventory with a cost of 100 peso each, you record this inventory in terms of value, which is 100 pesos times 100 pieces, or 10,000 pesos. You don't record 10 pieces of books. Instead, you record the monetary value of 10,000 pesos. Fourth is the going concern principle. So this is very straightforward and simple. It's simply the assumption that the business will go on indefinitely in the long run. The fifth, sixth, and seventh principles are actually somehow related with each other. Fifth is the matching principle, and from the name itself, we know that we are matching two things together. In this case, we are matching the expenses incurred with the income generated. So this principle assumes that there is a cause and effect relationship between the expenses incurred and income generated. For example, if the company incurred sales commissions to generate their June 2020 sales, then the sales commissions expense should be recognized in June 2020, the same month when the sales was made, even if the commission was paid in July. Next, we have the accrual principle. And to understand this, first let's look at this transaction. On June 1, 2020, Anna agreed to provide accounting services to Chloe for 20,000 pesos. Anna rendered the services on June 15, 2020. Chloe paid 20,000 pesos cash to Anna on July 5, 2020. And reporting is every end of month, and in this scenario, it's June 30, 2020. So the first thing we need to understand is that there are two sides in this transaction, Anna and Chloe. Anna will be providing the service and receiving cash, and on the other hand, Chloe will be paying the cash amount and will be using the service. Here are some terms which are commonly used in accounting transactions. On the left side, we have terms relating to the one who provides the service, and on the right, we have terms relating to the one who receives the service and pays. First, let's look at the words in green. Render means to provide. For example here, Anna rendered services, meaning Anna provided services. Earn means the point when the services have been rendered or when the goods have been delivered. So in this case, Anna rendered the service on June 15, and that is also the day when the income was earned. So when you see the words render or earn, that means that income should be recorded by the company on that day. On Chloe's side, we have the words use as in use of services and incur, which is kind of like the counterpart of earn, but the word incur is used together with expense instead of income. For example, incurred expenses amounting to 100 pesos. Both the words use and incur indicate that the service has already been used by the company and an expense should be recorded or recognized in its books. Keep in mind that these words in green all relate to income or expenses only. So these pertain to the point when the service has been provided or used by the parties and does not consider when cash has been paid or collected. Now let's look at the words in blue. These pertain to the cash flows, meaning the cash collections and payments. Since Anna provided the service, she will be collecting cash from Chloe, who will be making the payment. Cash movements should only be recorded once cash has been actually paid or collected. In this transaction, you will note that the provision of services and cash payment did not occur on the same day. The services were provided in June, while cash payment was made in July. And this is the reason why we have the accrual concept. because the timing of cash payments or collections do not necessarily coincide with when the service was provided or used. The accrual concept simply states that you need to recognize income when it is earned and expenses when incurred, whether or not cash has been paid or collected. You'll see that this accrual principle somehow supports the matching principle because by following the accrual principle, you are also able to properly match the expense with the related income and record them in the same period. In this case, according to the accrual concept, income should be recorded by Anna and the expense should be recorded by Chloe both in June, when the service was provided. The cash collection, on the other hand, should be recorded by Anna, while the cash payment should be recorded by Chloe in July when the actual cash payment was made. Next, we have the revenue realization principle, which states that revenue should be recognized only when it has been earned. You'll notice that this is somehow similar to the accrual principle, and this only emphasizes that income should only be recognized when the services have been provided or when the goods have been delivered to the customer. This means that revenue should not be recognized even when cash payments are received in advance unless the service has been provided. Next is the cost or historical cost principle, which states that most assets are recorded at the price when they were first acquired, or what we call the initial acquisition price. For example, if land was acquired for 1,000,000 pesos 10 years ago and its value today has increased to 2,000,000 pesos, we would still record it at 1,000,000 pesos, which is the original or historical cost when it was first acquired. Next, we have the full disclosure principle, and from the name itself, we have the word disclosure, which means to make information known to people. So this principle only tells us that the company should provide complete and accurate information that would be useful to the users. For example, the company must provide additional or supporting information that they think would be relevant to the decision makers. Now we have the concept of materiality, and this just pertains to the relative importance of an item or event. Material information or events are those capable of influencing or changing the decisions of the users once they are made aware of this info. So one thing you should note is that materiality is relative. It varies depending on the company or the entity. For example, 10,000 pesos may seem like a huge amount, a material amount for a small sari-sari store, but it would be quite negligible for a large corporation like SM. Second to the last is consistency, and this is quite straightforward. It just means that the methods adopted by the company should be applied consistently throughout from period to period, and this would allow comparability of information. For example, there are different types of inventory systems. We have the perpetual system or the periodic system. And if the company decides to adopt the perpetual system, then it should be applied consistently over the next periods as well. It can't apply the periodic system in the next period. Last is objectivity. This is also quite simple. Objectivity means to be free from bias, and this principle simply tells us that all transactions recorded in the company's books should be evidenced by supporting documents that are free from personal biases. For example, an estimates report should not be prepared based on the owner's personal opinion. Instead, it should be prepared by an independent expert. Alright, so now we're done discussing the principles. It's time for us to practice applying these concepts to real-life situations. Identify the principle that applies to the given scenario. 1. JGH Corporation applies the same method of depreciation for its equipment every period. The correct answer is consistency. Keywords here are the same method and every period. Consistency tells us that any method adopted by the company should be applied consistently from period to period. Number 2. Land is recorded at its original acquisition price rather than its fair or appraised value. The correct answer is cost or historical cost principle. The keywords are the original acquisition price or historical cost. 3. ABC Corporation's financial statements include notes providing information regarding the depreciation method applied to its equipment. The answer is full disclosure. Keywords are notes providing information. Remember that the full disclosure principle is concerned with providing additional information which would be useful to the users. 4. Tickets to Blackpink's December 2020 concert were sold in July 2020. When must YG Entertainment recognize the related revenue? The correct answer is December 2020, and the reason is because the revenue realization principle applies here. The principle tells us that revenue should only be recognized once the service has been provided, and in this case, the service promised is the concert, which would only be provided in December. 5. Freight costs or delivery costs relating to June 2020 sales amounted to 10,000 pesos. The amount was only recorded in July 2020 upon payment. Which principles were violated? The correct answer is matching and accrual principles. The matching principle tells us that the freight costs were related to the June 2020 sales and should therefore be recognized in the same period, which is June. The accrual principle, on the other hand, tells us that the freight costs were incurred in June when the actual delivery service occurred and not in July when the cash payment was made. 6. Anna's personal salon expenses are not recorded as expenses in the books of Anna's accounting services. The correct answer is the entity principle, which states that the business is a separate entity from the owner and that the personal transactions of the owner should not be recorded in the books of the business. And now we've reached the end. I hope you were able to get them all correctly, and if not, it's okay. Just go back and go over the principles, familiarize yourself, and most importantly, just keep practicing. That's it for today's lesson. I hope everybody learned something new. Please don't forget to like, share, and subscribe to our channel. And if you have questions or requests, feel free to comment down below. And I'll see you all in our next video.